What are the advantages of trading bullish leveraged funds over bearish leveraged funds? Is riding this bullish rally going to be like you were a cowboy riding a Brahma bull at a rodeo? What was the news on inflation that caused the rockets to start flying? Let's ride these rockets.
This is not financial nor professional advice. This video is for entertainment only.
Hey everyone. The big news that sent the rockets flying was the inflation news, which came in so good. It was expected to come in at 8% year on year, and it came in at 7.7%. Hey, these interest rate increases might actually be working. And month on month, it was similar good news. It was expected to come in at 0.6, and it increased month on month by 0.4. Core inflation, the news was also good. It was expected to come in at 6.5, and it came in at 6.3. Core inflation tends to be the sticky part and the part that the Fed probably worries about a little bit more. So this was very good news. And also the month to month core inflation increase came in at only 0.3% when 0.6 was expected. So these are starting to look a little bit more closer to normal. We're still a ways off. And this could be a choppy thing, and that's why it could be like riding a Brahma bull, simply because is this a one-off? Is this just an aberration and we're getting good news? I think it's probably better than that, because the container expenses for shipping things internationally has come down a lot. So transportation costs have come down. The price of oil is coming down. So that'll probably be good news. And we think the rent expense, the shelter inflation, as they call it, will probably be good news because the price of houses has come down. And the rent inflation, it's slower to start to decrease, but it makes up a big percentage of the inflation news. But we expect that to continue coming down. So we probably will have good news next month in December, it's hoped, especially if the energy prices stay low. The CPI report comes out December 13th, and the Fed announces their rate increase on December 14th. The interest rate tool is predicting an 80% chance of them only increasing at 0.5. Now, this is still an increase, but it would be the first decrease in the rate of acceleration of the interest rate in several quarters. And the market's expecting an 80% chance that they're going to go with 0.5. And then the next question will be, and they will ask him this during the interview portion, are you thinking of pausing? And if he says he's going to pause, or hey, we don't see a big need to go beyond 0.5. I mean, anything will be interpreted positively. So we're going to have a wild 2 days on the 13th and the 14th, and hopefully it'll be good news. I don't want to be shorting any funds right now. And basically, I think ETFs, and especially leverage ETFs, might be the way to play this choppy market. It's basically, I think in the short term, we're in for choppy action, okay? Because we're debating, is this the real thing or is this a one-off? But I tend to lean towards it being the real thing and that the interest rates are working. Tesla, Meta, and Google, for example, are all either cutting staff or at least reducing expenses. And the Federal Reserve loves to hear this. This is music to their ears. They want to see employment go down, as horrible as that sounds. But they know from experience that's what has to happen to bring inflation in line, which is really the bigger threat right now. And so they have to reduce it enough that inflation expectations do not go up. And frankly, trading bearish and especially bearish leveraged funds is a pain. I want to say it's day trading, but I really want to say that it's more like minute trading. I've made a lot of money on SQQQ, which is the ETF of the 100, it's the inverse of the 100 largest companies on the NASDAQ. And I've made a lot of money on that. I've made like $400,000. I got whipsawed, of course, a little bit at the end. You will always get whipsawed at the end when it breaks into a bull market. But I've made good money with SQQQ. But I think those days are over, or at least the bulk of the downside of this stock market is probably over. It could go down more, but I think we've caught the majority of it, and you're ahead to do more swing trading now. And bearish funds do not lend themselves to that. You have to be on it every second, because the market tends to go down like an elevator, but it goes up like an escalator. And also, if you hold bearish funds for a long time, you eventually will go near to zero, especially leveraged funds. If you look at their long-term track record, you end up at zero. And so the only time I will do this, go bearish, is when the market is generally crashing. And I do it on a minute-by-minute basis, and you got to be on it every second. With bullish funds, I don't think you need to be on it every second. It's more like swing trading, at least to begin with. And if it turns into a long-term bullish market, hey, we can go with it. You know, you could hold on to a bullish ETF that's leveraged 3 times, and you could win if you left it on there for a year or two, okay? Healthcare would be an example. But if you did that with a bearish fund, the market almost inevitably goes up. You leave it up on a couple years on a bearish fund, you're likely to be a loser and could lose it all. I previously had recommended more defensive triple leverage ETFs, but now I'm going with the more bullish triple leverage ETFs. I think the defensive ones still have validity and will show their validity in this choppy market. But for now, I think we have a month here of the coast is clear and it's time for bullishness. The only thing that will temper this is that the Federal Reserve board members will probably start talking more hawkish the more the market goes up. You actually don't want the market to go up too much, because if it does, they will start talking more and more hawkish, like they're going to do 0.75, okay, which will put a big dent in the market's optimism. But I think for right now, the coast is clear until we hear different from the Federal Reserve Board. Everything is bowed down to the Federal Reserve Board, because they created this mess and they're undoing this mess, and so everything depends on what they're doing. But my favorite for right now is TQQQ. You triple your fund. You triple the uplift on the 100 largest companies listed on the NASDAQ. These are the FANGs, plus others. It's Facebook, Meta, Apple, Amazon, Alphabet, Netflix, Google, plus Microsoft, plus Tesla, makes up the bulk of this fund because it's a weighted average. But it took off, of course, like a rocket, and it's going to be choppy flying, I think, depending on what the Federal Reserve says and does. I wanted to show you this chart because it shows the massive differences between these triple leveraged funds and your average ETF. And the TQQQ, the triple leveraged fund on the 100 largest companies on the NASDAQ, is in green at the top, and they made around 30%. Okay, the SQQQ on that same day, well, this is over 5 days. Over 5 days, TQQQ made 30%, and over 5 days, SQQQ made a negative 28%. Okay, so you can see these funds are rock and roll. They're going to move. I like triple leverage ETFs simply because they move like individual stocks, but you have the diversification, and I think it's a good trade-off. If you want to assume, well, we're in a better stock market now that's probably going to gradually improve, you may be ahead to take the blue line, take the QQQ, which is the unleveraged, it's just the straight 100 largest companies on the NASDAQ, and that would be a way of playing it safe, but yet participating in the uplift. SQQQ, you have to be on that every minute, and I only do it when the market is bona fide crashing. And the VIX is lower now. The VIX is heading towards 22. If the VIX is lower than 25, I don't short anything because the shorts tend to trade together. They tend to all go up or all go down together. They're correlated with each other, at least in my mind. And so I will not short anything with the VIX lower than 25, which is what's happening now. The next triple leveraged fund I like is TNA, which is triple leveraging the small cap Russell 2000. And so you're getting a lot of the smaller stocks, and the smaller stocks tend to be the ones to recover first and maybe recover the most. If this is a strong recovery, this would be the case. Again, with all of these, I'm expecting choppy action. So you will hear what the Federal Reserve is saying day to day as affecting the stock market. And so, but I think as long as we got a rally going here, I'm going to triple leverage it, and it looks like it's a good time to buy. And again, I'm showing you this chart contrasting TNA, the triple leverage bullish fund on the Russell 2000, and I'm comparing, that's in green, and they made 11%, and contrast that with the inverse fund on the Russell 2000, and that's TZA. And TZA lost 11% during those 5 days. And you can see the allure of leveraged funds. And actually, TZA was well ahead of TNA early in the week. But then we got that inflation news, and it just sent the rockets flying. And we ended up with TNA scoring a major advance, while TZA went down 11%. No, it went down 13%. If you want to just play small stocks and assume that the market is in an uptrend and we will have choppiness, but you want to benefit from the small stocks going up, the symbol for the unleveraged fund, the regular fund I will call it, is IWM. IWM. The next fund I like is FAS, which is the triple leverage bullish fund on financial services and banks and so forth. And It's triple leverage and it went up massively. Financial services tend to do better with higher interest rates, and the Federal Reserve has already promised that they're going to increase it by probably 0.5% more in December. And future rate increases will depend on the inflation data. But in any case, Powell indicates once they get them to a certain height where things look good, where they're controlling inflation, and they're a long ways from that right now. It's 7.7%. They want to get down to 2%. So it's likely that these interest rates will be increased and then held for at least like 6 months at least or more. So financial services makes a lot of sense to triple leverage right now. Looking at the chart, I'm contrasting the triple leverage bullish fund FAS with the triple leverage inverse fund, the bearish fund FAZ. It's the inverse, and so it's negative on financial services. And FAS, which is in green, you can see it went up about 15% in the last week, and FAZ went down about 15% in the last week. And of course, there's a middle road. The Buddhist method is to follow the middle road, which you may want to do. I took the middle road for me would be the financial services sector, which is XLF. And in the last 5 days, they went up about 5%. And that's probably the safer way to play this, unless you're a crazy trader like me and likes to do the leverage thing. XLF would serve you well. But I think I think FAS would also serve you well. If this information is helpful, please hit the like button. The next thing I think about buying is oil, because as this rally continues and demand goes down, assuming it's not totally quashed by the Federal Reserve, which could happen, and oil prices are affected by so many things that I'm a little more hesitant to go on oil, but I probably will double leverage it rather than triple leverage it. If you are knowledgeable about oil and you feel like, yeah, we're going to 120 again, NRGU is the triple leverage fund on 10 very large oil companies. I'm probably more likely to buy the double leverage fund on oil, which is GUSH, G-U-S-H, and besides, I just like the name. It's like an oil gusher, right? There's also a double leverage inverse fund on oil. If you think the price of oil is going down, it's like 85 now. It's hard for me to see oil going down given the war in Ukraine and world supply problems. But if demand falls down, if we go into recession somehow and this inflation number was just a fake out, then it's a possibility. But I think probably the more sensible course is to take the road in the middle, as the Buddhists say, the middle road, and go with a VDE, which is an unleveraged oil fund from Vanguard. And they do both large companies, mid-sized companies, and small companies. So you're getting a broad range. VDE is about 52% large companies, 36% mid-cap companies, and about 12% small companies. So you're getting a mix of the various sizes of oil companies. So looking at the chart, you have NRGU, which is the triple leverage fund on very large oil companies. It's like ExxonMobil, Chevron. Those two make a large part of it just because they're such huge companies. But then you have Marathon, you have Phillips 66, you have Conoco, all the usual suspects in the oil business. But NRGU has gone up 112% in a month. Oh my God. GUSH, the double leveraged ETF on oil stocks, has gone up 52%. VDE has gone up about 26%, while DRIP, betting against oil, the double leveraged inverse on oil, has gone down about 48%. So you don't want to bet against oil. I'm probably inclined to go more with GUSH just because I think it's a little less risky and I can live with 52% in a month. Okay, VDE is probably the more sensible way to go. I think you're not going to get jackknifed around as much as you are at risk with the leveraged funds. And DRIP is definitely saying you don't want to bet against oil. I did want to talk about previous leveraged ETFs I've had invested in. One was Yang, Y-A-N-G, and it's leveraged 3 times on Chinese companies that trade, Chinese stocks that trade on the American stock exchanges. And it's very unpredictable. And if you go to my YouTube channel and you look at the comments I made to different people on Yang, I warned that it was very unpredictable, and I warned when it was topping out that it was very unpredictable and that it was hard to gauge. And that's true with any Chinese company, simply because they don't have full disclosure, as we would call it in this country. They're not as transparent. It's harder to see what's going on in China. And the reason it's an inverse fund on Chinese stocks that trade on American exchanges. So when China isn't doing well, Yang goes up massively. And recently, China has been talking about reducing the quarantines and reducing the lockdowns. They're talking about targeted lockdowns now, and they're letting more flights fly in, and they're not blaming the airlines if they should happen to bring someone in who is infected. So they're trying to open up somewhat, but I'm not bullish on China. I think they have way more problems than the United States ever imagined having. And I see them much more in the situation we were in 2008, because their problems is in real estate, and our real estate is less of a problem. Let's put it that way. Also, I wanted to talk about Kier. That was the triple leveraged healthcare fund, and it's doing well. It gained on the week, but both I also show on there in blue. I show DFEN is the blue line, and the green line is Cure, C-U-R-E, and they both did relatively well, but I'm concerned that they both shot up on Thursday when the inflation data was announced, but then they came down on Friday. Kier still managed to eke out a gain for the week, whereas DFEN took a small loss. But DFEN went up so high on Thursday, and then it came down like 10% on Friday. So I don't like that price action. I think we might be in some choppiness. I think what happened, particularly in the case of DFEN, DFEN, I think what happened in that case, it's a case of people getting out of the defensive stocks and going into the triple Qs, going into the more bullish stocks. And the best way to do that, in my view, if you want the triple leverage, is with TQQQ, although QQQ will probably do you well also. So I think it's just a case of shifting to the more bullish stocks. I think both of these are good long-term holds. I am more concerned about DFEN though, DFEN. That is of concern to me. But I did want to talk about those because I have talked about them in previous videos, and I want to give you some continuity. Also, I want to reach out to you and say I really enjoy the YouTube comments. It sharpens my thinking, and I like the challenges. It incites me to do more research on the things that I'm looking into. And I also could do more videos on more alternative ETFs. If some of you would like to see that, I'm very open to doing that to give you more choice in this crazy and wild market. So that's all I have for today. That's how I roll. Thanks for listening and watching. Be sure to smash the like button, subscribe if you haven't done that, and good luck to us all. Thank you.